Good afternoon, everyone, and thank you for showing interest in this webinar on impact investing in the time of COVID. If I could please ask you to enter any questions you may have during the course of the presentation, and then I will field those at the end. Like many things, the current crisis is highlighting already unsustainable trends that were happening prior, but it's also heightening the urgency for government and the private sector to work together to forge a more inclusive growth path. We already know that we as South Africans have one of the highest unemployment rates and amongst the highest levels of inequality in the world, and that was pre-COVID. Crumbling infrastructure and challenges in our healthcare response, for me, actually invoke a kind of fight or flight question. And I believe that impact investing, and more especially blended finance solutions, can help to solve many of these challenges. And I really hope it's going to invoke the fight response. So globally, there's been a coming together of impact investors called the R3 Coalition, led by GIN, the Global Impact Investing Network, but also many others such as Andy, both of whom we are members of. And what they're doing is driving a strategy that says we need to get behind three phases in response. Well, the first is response, recovery, and resilience. And in the near term, these organizations are coordinating funding efforts as a response for immediate health and social needs. And this response phase features funding which is largely dealing about an immediate need to respond to this emergency. But the recovery phase then is largely about maintaining or restoring infrastructure, things like jobs, and or perhaps providing ways or finding ways to provide soft capital. And then the third level is to build more resilience in our world, but more on that later. So many have observed that there is also deepening economic dualism within states. And what do we mean by this? This is because there is such a stark divide between technologically advanced and globally integrated parts of our economy and versus the lagging sectors and regions we know so well. This is a global phenomenon, of course, but in South Africa, the inequality is extreme. And apart from contributing to insecurity and a polarizing backlash against the other, this is also bad for productivity because large segments of our population are not integrated with the economy at large. So this is not just a problem of exclusion, but it's also a problem of underperformance. And therefore, we increasingly need more effective policy and practices that drive social inclusion and growth productivity, not separately, but as one, particularly investing in the real economy. So there's an awakening to the notion that the social and environmentally targeted themes underpinning impact investments are ultimately fundamental to a well-functioning and prosperous global economy. The Sustainable Development Goals estimated pre-COVID that the funding gap to meet its targets by 2030 was $2.5 trillion per annum. This is the contribution needed from the private sector in addition to government and philanthropic spending. Impact investing offers a new alternative for channeling funding strategies to tackle the world's greatest environmental and social challenges. In South Africa, these sustainable development goals are very closely aligned to our national development plan across 6 key thematic areas: equality, economic infrastructure, education, health, environment, and peace and justice. And important to recognize as well is that all these themes offer investment opportunities too, often in collaboration with the public sector, which brings us to a discussion about blended finance, because that's really what blended finance is all about. So blended finance, as defined by the OECD, is the strategic use of government development finance for the mobilization of additional private finance towards sustainable development in developing countries. And we know that governments are pumping out capital to try and save economies and bridge financing gaps around the world. But it is also apparent that government funding alone is unlikely to be sufficient. Well, it can't be. It's insufficient to solve this immediate crisis. Nor can it be relied on as the only solution for the longer-term investments required to build stable, resilient systems. So what does blended finance look like? Well, it's pretty flexible. It can be aimed at explicit developmental goals or not. It could also utilize concessional layers of capital from the public sector, such as grants or first loss mechanisms. Or it could see no concessional participation or layers, but rather investments by public and private alongside one another. And there's much in between. So they're flexible structures with the single end goal to contribute towards the SDGs. Now, if we draw parallels to this pandemic, investment in addressing climate change used to be mostly in the purview of scientists, governments, and committed activists. That was at least until it started to actually tangibly affect us as individuals. Similarly, we believe investments in social infrastructure, be it access to healthcare, clean water, education, and affordable housing, have predominantly been left in the hands of governments and development banks. However, packaged correctly and providing attractive risk-reward characteristics, these are all fundamental investment areas that could see more private sector investment and involvement. In the current circumstances, we're also seeing new areas of impact investing emerge. For example, the thriving demand for the goods and services in sectors like online education, telemedicine, localized regenerative agriculture farming, and also essential delivery services that are not reliant on long, complicated supply chains, like the little delivery motorbikes that we see scooting around. We know, too, that climate change will disproportionately affect those at the base of the economic pyramid. And as we are experiencing with coronavirus-related deaths and job losses, the same is true of this pandemic. The crisis has highlighted the case for purpose-driven inclusive finance across both the environmental and social sectors, which is really at the core of impact investing. So as we say, at its core, impact investing incorporates blended finance solutions, and it's directly speaking to SDG 17, Partnership for the Goals. This is where impact investors partner with local or international government bodies or agencies. As we see at the bottom of this slide, many international bodies like USAID, DFID in the UK, the IFC, and the African Development Bank are all active catalysts in many blended finance solutions. But interestingly, and perhaps somewhat inadvertently, a recent study to determine what the most important features of impact managers internationally is found that collaboration between public and private was central, so blended finance. The four most important and consistent factors behind success were partnership with the public sector, the use of catalytic capital, multilingual leadership, by which we mean the ability to converse and collaborate across diverse stakeholder groups, such as incorporating NGOs or academic insights. And then lastly, impact investors need to target uncompromised financial as well as impact returns equally. Okay, so I'm now going to cheat a little bit, knowing that you need your CPD points, and use you a little bit as my guinea pigs to test my current master's dissertation. Still a work in progress. The topic of my research is how public sector-led blended finance solutions can create sustainable employment in South Africa. So this is a field that I work in, and so my curiosity is about how public investments can be used to reduce risk in order to crowd in private commercial investment for development outcomes. In South Africa's context, we know we have one of the highest unemployment rates in the world. The expanded definition of working age people puts it at about 39% in the most recent reading, which is unbelievably high and going to grow higher. Our private sector is well capitalized through the banks, the pension funds, and the insurers. But lending to SMEs and the associated job creating opportunities is very low by global comparisons. So I explore blended finance as a means to solve the finance gap that has been identified for these SMEs. And as you can see from this smorgasbord of blended finance in the bottom, it looks very complicated. You'll be relieved to know that my study focuses just on one particular instrument, namely guarantee mechanisms, the third one at the bottom, which tend to be relatively underutilized. And my honed-in specific research question is, how then can guarantee mechanisms be used more effectively to address credit market failure for SME? So let me share some of my preliminary findings with you, and I hope that it sparks many questions from you. So I tackled this by obtaining data from the only 3 large credit guarantee schemes with a decent track record that lend to underlying SMEs. SMEs globally are shown to be the strongest job creator, but South Africa's lagged this for decades. So my study is interested in determining, first of all, whether there is an access to finance problem for SMEs, and then to determine whether credit guarantees can usefully address this, firstly, and secondly, whether we can rely on the job creation outcomes that they target. And this is important because we're trying to establish whether public funding is actually justified, i.e. do these guarantees promote job creation, and how can we know this? Because ultimately you and I as taxpayers need to know that we're getting bang for buck in terms of impact results. So the 3 credit guarantee schemes that I obtained data for are Atlantic, the fund that I continue to manage at Ashburton, but which was created when we were at Atlantic by partnering with our National Treasury's Jobs Fund, which is the second column here. Although our fund is the only one utilizing a guarantee that is represented in the enterprise development window here, the Jobs Fund does work on a challenge matched funding basis. So a blended finance approach that targets job creation as its income outcome is highly relevant here. The second credit guarantee scheme is Kula, which is operated by CIFA under the DTI. It's been around since about 1996, but has shown very mixed results. The third scheme is Tembani, funded by a well-known NGO based in the US called Shared Interest. And I then conducted semi-structured interviews, having analyzed the data with key people working at both the guarantors, coolers, etc., as well as the asset manager and banks utilizing these guarantees. So in order to better evaluate the effectiveness and sustainability of guarantee mechanisms in blended finance solutions, I used a framework that is utilized quite commonly within this blended finance concept by the OECD's Development Assistance Committee, or DAC criteria, down on the left there, of relevance, efficiency, effectiveness, impact, and sustainability. This allows for a comparison and insights across the case studies, and in particular examining the relative data on the amount of guarantee leverage, that is, how much private sector funding have these guarantees raised in addition, default rates, and then job creation. And then, importantly, evaluating and turning to the quality of this data. So looking at how reliable particularly the job creation data is. So think of the DAC criteria of relevance, efficiency, effectiveness, impact, and sustainability as units of measure to evaluate the overall efficacy of blended finance solutions. The first 2 criteria of relevance and efficiency show us how much private sector funding can be leveraged. And so we see some interesting trends emerging. One of the most striking ones is to note the importance of benchmarking. We can see that for Jobs Fund and Atlantic, very clear targets were set up front, and success is measured against these. And this does tend to lend credibility to the outcomes. But we can see for Kula and Tembani, there are no upfront targets. They've both been in operation since 1996. They've both raised fairly considerable amounts of private sector capital, but we have no way of evaluating or verifying whether it represents program success relative to benchmarks. Unfortunately, there's too little time to flesh out all the detail, but if we look at job creation by way of example, we see that Atlantic is a little ahead of its original target of 9,635 jobs. The Jobs Fund overall program is more or less in line, having created 73,500 jobs. And these create important positive track records known as the demonstration effect. While Kula states 69,000 jobs and Tembani an impressive almost 2 million jobs. However, when you analyze the efficiency measure by way of cost of grant per job, we see that Tembani's, for example, average cost to create a job is just 162 Rand, which really does open up a large credibility gap. Another area that speaks to the overall impact and sustainability of guarantee mechanisms for blended finance is moving beyond the numbers at face value, even where they have been benchmarked, and to ascertain the actual quality of the results. Difficult to do, but really important. The reliability and the integrity of the job creation data. This, together with the default rate, speaks to the overall sustainability of these guarantee solutions. As far as the quality of the impact is concerned, there has been a very clear intention, driven by the Jobs Fund program, to have agreed evidencing, which is then verified and ultimately independently audited by the Auditor General at the end for the Atlantic Fund. And the emphasis was on decent jobs defined as earning above minimum wage, being evidenced in place for a particular amount of time, etc. So ensuring that these are decent jobs. However, unfortunately, no such real credibility can be assigned to the Kula or Tembani guarantee schemes as far as the job creation data is concerned, as their numbers are self-reported with no clear verification process in place. As far as the default rates are concerned, Tembani and Atlantic are within the norms suggested by the literature for guarantee schemes to be sustainable. However, data for this has been difficult to obtain from Kula, and a previous study put the default rate at a very unsustainable 42% from 2006 to 2010. With respect to the risk theme, without fail, interviewees stated that credit rationing to SMEs is real and pervasive. However, guarantees seem to have mixed results in mitigating this, and also access to finance is, of course, not the only challenge. With respect to impact, the quality and verification of job creation varies greatly across guarantee schemes. One strong explanation put forward for this was a finding that most owners of capital, and this is largely the banks, do not report on impact in the absence of being held accountable, which Kula and Tembani also do not do materially, i.e. hold the banks accountable. Whereas the Jobs Fund has held Atlantic to a very high standard of accountability within its own high standards of governance and accountability to government requirements within PFMA frameworks, etc. In exploring possible reasons for relative success in reaching impact targets, I tested the notion of a possible agency problem, in that the private sector is not actually the direct beneficiary of the targeted job creation, and that therefore, absent capable state oversight to ensure better impact target delivery, blended finance intentions are likely to undershoot their objectives for both public and private sector participants. So really you can see how important it is to have a capable state oversight. In our instances, I'm afraid a bit of a pocket of the state, but nevertheless very powerful in demonstrating, how results can be meaningful if there is proper, capable state oversight. So here's a little bit more color and detail on the scope and quality of the job creation statistics for our credit-enhanced fund utilizing that Jobs Fund guarantee. So not only has the fund exceeded its job creation targets, but also in critical areas of previously disadvantaged, 98%, and also reaching relatively underserviced provinces, Eastern Cape, Limpopo, and Northwest. So moving on to the current environment and having a look at more closely at the role of state in the current COVID circumstances, our government a few weeks back announced a very large emergency intervention package of around 500 billion rands. Now the largest component of that is actually a 200 billion guarantee scheme, which will be administered by Kula, which I think you get a taste of from the previous data I shared with you, is a concern. What you couldn't see in that data was an even larger concern that I have, in that the Kula guarantee scheme through the banks is really broken when it matters most. And you get a good idea of, in terms of data I obtained from them, which shows the red line is Kula guarantees to the banks since 1996, and then the green line is the bank loans associated with those guarantees to SMEs. And we can see that there's a very striking effect of the dramatic decline in Kula guarantees from about 2007, and the effect that this had in terms of subsequent sharp declines on bank lending to SMEs, which have really dwindled to almost nothing over the last several years. This was largely attributed to administrative and dispute process issues that escalated connected to Kula's claim process. So it kind of, the system broke down. And, you know, given what I've uncovered in my research and looking at the broken state of Kula's ability to transact through the banks, there seems to be, sadly, a very big question mark about whether necessary funding will reach SMEs through this vital intervention now. But another area where government and private sector can and needs to collaborate, which we hope will show promise, is in the recently announced Office of the Presidency's drive to attract 2.1 trillion rands over the next several years from private sector to help fund much needed infrastructure in 6 critical and priority areas that the Presidency's office have identified and linked to the NDP. And these are digital, energy, transport, water and sanitation, agriculture, and human settlements. So I guess time will tell whether we can succeed at building blended finance solutions in these much needed areas in order to propel our country on a more sustainable and inclusive growth path. But they are planning a symposium towards the end of June to galvanize this collaboration between public and private. And finally, I just want to share with you some thinking from a prominent economist called Dani Roderick, which circles back on blended finance. He argues that we need to shift away from traditional approaches to industrial policy, where governments assume that they're in control and know all market failure in advance. However, they're prone to state capture, as we sadly know. They tend to approach solutions with rigid instruments and ideas, and he argues that this is not optimal, and that in the real world, where there's so much uncertainty and changing circumstances, it's a more modern approach is more likely to work well. And this is where we need to assume that actually market failures are largely unobservable ex ante, that there are actually multiple stakeholders with information, and that the state capacity needs to be endogenous to the economy's workings. In other words, and this is the critical requirement, we need that capable state. Then what he advocates has a strong mirror in creating blended finance solutions, as the modern approach relies on the identification and objectives and constraints through strategic collaboration with firms, and then a sort of iterative feedback loop process and collaborative behaviors of learning, cost discovery, and error detection. So my early findings in terms of my studies were that guarantees under circumstances of credit rationing do seem capable of transcending some of these risk perceptions, and over time can normalize investments through developing track records or that demonstration effect. However, in the absence of a robust accountability framework, private sector agents of guarantee mechanisms will likely fail to achieve good quality impact outcomes. The study concludes that the sustainability of these guarantees depends on effective and iterative partnership with a capable public sector, specifying clear contract terms, as well as a robust accountability framework that targets impact outcomes or job creation with explicit measurement and verification thereof. So I hope that this is useful in providing some insights and perhaps policy direction and reform as to how public guarantees could be more effective in catalyzing much needed financial capital to alleviate unemployment and other areas. So thank you very much, and to finally leave you with a thought on your proverbial home couches. We are a gloomy bunch, but I think it's good to know and recognize that we are the most confidently wrong country in the world. So we tend to think that things are way worse than they actually are, and we do that more than anyone else on our planet. So, for example, in terms of the murder rate, on average, we think it's 30% higher than it really is. Teen pregnancies, we think, are at 44%, where they're actually at 4.4%, and so on. And I just hope that we get to a point where we realize that actually we are all capable of making things, they are a whole lot better, first of all. Doesn't seem like it, but that if we pull together and we do have instances like our REAP program where we have pulled together the SASME fund more recently. We just need to see more of that, and we are richly endowed with savings. We are collectively quite capable of building out a more sustainable and inclusive growth path for our economy. And I thank you. And if I could ask you please to stay on for questions now, and I'll field them. Thank you very much for your attendance. Okay, so turning to questions, so I see the first question coming through asks, can you explain why you think National Treasury's Jobs Fund has been able to hold Ashburton more accountable? Okay, that's interesting. So we've been working with National Treasury's Jobs Fund program since 2013, and I think that there are probably two main elements to this. Interestingly, when I actually first started my dissertation, I was quite arrogant and thought it was a private sector-led initiative because it was our idea. But actually, these blended finance solutions, I've come to believe, need to be public sector-led. And so two elements are important here. The one is very contractual, but the other one is relational. And I'll unpack that a little bit. So in terms of the contractual side, that's where we held accountable because we're receiving a grant. So we're receiving taxpayer money, essentially. And their Treasury, and I'm sure many of you in the audience have experience of dealing with our National Treasury. They are generally highly competent. Certainly the Jobs Fund team are very impressive across all levels, and where it really matters for us in terms of reporting to them around accounting for funds that we receive for grant, but then also for accounting for the actual jobs. There's a very thorough, well thought through process of reporting that happens there in terms of the evidencing and the verification and ultimately the auditing of those jobs fund numbers, because Treasury are always very clear to us that they in turn need to report into PFMA, into Parliament and into the Auditor General ultimately. But then, so that's the one side. But then the other side, which is the more intangible, is, over time, I always say the spirit of the law is more important than the actual law, because if you go into something not really intending to do it, it's unlikely to have a good ending. And so in this instance, the relationship that we've built with Treasury over the years has I think, in equal part been as important in terms of understanding why this matters, and being able to negotiate as we go, because this, you can't, especially because this is an innovative field, you can't know for sure exactly how it's going to pan out going into it. And so you can't be rigid in terms of that contracting, and there's a kind of a negotiation process as you go, and a process of building trust. And I just think that National Treasury have been very, very good at that, actually. I hope that's answered you. Another question coming through is, are there any other fund models that utilize guarantees in the market? Yes, so South Africa's probably been a little bit of a laggard in terms of this. Obviously not when you're looking at something like Kula, for example, because, or Tembani. They've been around for a long time. But in our world, in the fund management industry, they haven't been around for that long, but I am aware, and this is again an intention behind the Jobs Fund model, because they are a matched funding challenge fund, and because they seek out innovation. Part of what they want to achieve is advocacy, is learning, and then being able to replicate and scale. And so we've always been very open to talking to, what you might think are competitors. So two that I'm aware of, that we do speak to. One is 27-4, who have I'm not sure of the exact structure, but it's a concessional layer in their fund structure for a fund of funds private equity vehicle, which is fairly recent. So they've been putting that together. And then the other one that I'm aware of, again with Jobs Fund participation, is run out of the Bertha Centre, which is the Green Outcomes Fund, which is like a social outcome bond, or those kinds of vehicles, but focused on climate change. And there are a number of partners in there, such as, I know Prescient are involved, and WWF, and I think Alexander Forbes actually also in that structure. I don't know too much about it, but it'd be interesting to see how that works out. That's very new. That fund was only launched in January of this year. Okay, let me just see if there are any other questions coming through. There's another one here which asks, is the government looking to make the infrastructure fund a blended finance vehicle? Okay. So I don't know. We've had a few engagements wearing my ASISA hat. So I sit on the investment and savings subcommittee for that, and that's where this has come through from the presidency. It's very exploratory at this stage. It's also large and targeted at several sectors. So I would hope that they'd explore a blended finance vehicle in some of these instances. It's still so new, though, as a concept. So if you remember years back, we had the PICC, which was another big infrastructure drive coming out of Ibrahim Patel's department at the time, and that sort of didn't really get traction. So we've had a few of these initiatives, a few attempts, and I guess our hope is now that we'll take learnings, we'll look at where things have worked. I think blended finance is working well in some pockets for government, and I think there's also a large demand for infrastructure type assets from the private sector. I mean, I can tell you when we had the call a couple of weeks ago with the Office of the Presidency, there were well over 100 people on that call. Most of them were, ASISA members, and actually some not ASISA members as well. So there's a huge interest. I've never seen a call as large as that. So I think there's a massive interest, and I certainly think that, yes, blended finance could play an important role in that. And I think government is signaling that they want to partner with private sector. Absolutely, I hope we can build that out. Thanks for the question. Another question coming through is, though this is a challenging time, how is Ashburton Jobs Fund assisting their investees financially? And is there a criteria they need to meet or to receive this assistance? Okay, that's a good a question, because it reminds me just to share again something from the Jobs Fund program. Is well over a month ago now, I forget the timing exactly, but they launched an initiative which was pretty proactive to say, look, we know times are very challenging, and we'd like to reach out to our beneficiaries to provide some form of relief funding if necessary, and if it's going to help tide beneficiaries through these tough times. And so we took the view that we didn't require assistance ourselves, but some of our underlying investees could well. And so actually we have been working, and we're hoping it'll receive final approval actually tomorrow. I had a call actually earlier today with the recipient. This is one of the underlying investments that we have, which is actually, I won't mention the name, but they provide loans along a Grameen Bank model, which is group lending to almost all women in rural areas. So really, they've been around since 1993, have an excellent track record. But they are lending deliberately to vulnerable people. And by the way, it's an example of, we've been lending to them for many years now, and they are financially very strong, have pretty deep shareholders of reference, and are able to actually raise financing internationally as well. So they've been, and their bad debt ratio has been kept cumulatively below 1% in all these years. Obviously now it's a very testing time, and so what we're hoping to do is reach 10% of their client base, which is about 20,000 people, 20,000 vulnerable women with a once-off grant payment, because they have such excellent systems, and they're able to identify who the most vulnerable are first of all, and because they have this, the loan system set up, they're able to disseminate or distribute that pretty efficiently. So we're really hoping that that is something that we're able to get out to those clients in the very near term. Thanks for the question. I'll just see if there are any others at this stage. I don't see any other questions coming through, so it's just left for me to thank you very much. Thank you for your engagement, and please stay safe and warm in this icy weather.